Hello guys, mkoaje? Mko poa? Pia mimi niko poa. This is Macharia, your CPA teacher, and for today I'm here because of advanced financial management. So for those wenye mnafanya advanced levels, have your notebook and a pen. Tumeendelea by the way. So if it's your first day or first lesson, jaribu catch up with us. Tumesoma vitu kadhaa, and I think it's good to revise. So anza from episode 1 mpaka mahali tumefika, and najua exam is this month. So be well prepared. Use all the materials that are available. Yeah? And I know mtapass. So for today, tunaanza mahali tuliachia last time. Take your notebook and a pen. Tunaendelea with our lesson. That is audit reports. Audit reports. So under that, ndio tuliacha kama subtopic, and we shall tackle some ratios. Yeah, rest time tuliangalia watu wenye wanatumia financial statements. Yes, tukaona watu kadhaa wanatumia financial statements, and it's good to know all of them. Ukiambiwa highlight, explain, yeah, elaborate, users, so you are in a position to answer any question that tackles something to do with users of financial statements. Also, in our last lesson, tulisoma objectives of financial statement analysis. Pia hiyo soma. If any questions comes from there, you can be able to answer very comfortably. So for today, I hope now you have your pen and a notebook, and let's start. I've said we write a subtopic, audit reports. Audit reports, and under this nimesema tutaangalia some of the ratios, yes, used in audit reports. So we write something small. When an independent auditor performs an audit, the audit report is usually addressed to the shareholders of the audited enterprise. The audit firms frequently also prepare a management report which deals with a wide variety of issues encountered in the course of the audit. Such a management report is not a public document. So, management report, it's just for the directors or the management of the company, and the public cannot access it, not unless shared with the authority of the management. So, however, it is a useful source of financial information. The directors ama management inaweza jua, yeah, which are the problems that the company is facing, risks zenye kampuni iko nazo. That report is very, very important to the management. So, under that, we write a small subheading: uses of financial ratios. Uses of financial ratios. Number 1. This is a very key, also very key subtopic to note. Uses of financial ratios. 1. For evaluating the ability of the firm to meet its short-term financial obligations as and when they fall due. for evaluating the ability of the firm to meet its short-term financial obligations as and when they fall due. 2. To interpret the performance of the firm over the period covered by the financial statements. 2. To interpret the performance of the firm over the period covered by the financial statements. 3. For comparison of the performance of the firm, this can be done in the following ways. Number 3. For comparison of the performance of the firm, this can be done in the following ways. Roman 1. Cross-sectional analysis. What is this? Cross-sectional analysis. The performance of the firm in question is compared with that of individual competitive firms in the same industry. So, the performance of the firm in the question is compared with that of the individual competitive firms in the same industry. Roman 2. Trend or time series analysis. Trend or time series analysis. Under that, the firm's performance is evaluated over time. The firm's performance is evaluated over time. So that was under number 3. Number 4. For predicting future performance of the firm. For predicting future performance of the firm. And number 5. To establish the efficiency of assets utilization to generate sales revenue. To establish the efficiency of assets utilization to generate sales revenue. And number 6, to establish the extent which the assets of the firm has been financed by fixed charge capital. To establish the extent which the assets of the firm has been financed by fixed charge capital. Limitations of financial ratios. Subtopic: limitations of financial ratios. We have several limitations. And number 1, ratios are computed at a specific point in time. Ratios are computed at a specific point in time. 2, ratios ignore the effect of inflation in performance, which is a vital part in the daily business management. The ratios ignore the effect of inflation in performance, which is a vital part in the daily business management. 3, the comparison between firms is often done even for firms with differences in size and technology. The comparison between firms is often done even for firms with difference in size and technology. 4, ratio analysis engages the use of historical data contained in financial statements, which may be irrelevant in decision making. Ratio analysis engages the use of historical data contained in financial statements, which may be irrelevant in decision making. And number 5, the different accounting policies applied by firms in similar industries, let's say in depreciation calculation, is a hindrance to comparison. The different accounting policies applied by firms in similar industries, let's say in depreciation calculation, is a hindrance to comparison. So those are some of the limitations of ratios. And we have now types of ratios. Types of ratios. We shall start with writing something small. Ratios are boldly classified into 5 categories. Ratios are broadly classified into 5 categories. Which are these categories? 1, liquidity ratios. 2, efficiency or turnover ratios. 3. Profitability ratios. 4. Gearing ratios. And 5. Investors ratios. So we start by number 1, liquidity ratios. Liquidity ratios. What is liquidity? We define liquidity refers to an enterprise's ability to meet its short-term obligation as and when they fall due. So inaweza kujitegemea, yeah? Its expenses, kama inahitaji kitu inaweza kujitegemea. Liquidity ratios are used to assess the adequacy of a firm's working capital. Full stop. Shortfalls in working capital may lead to inability to pay bills and disruptions in operations, which may be the forerunner to bankruptcy. They are also known as working capital ratios. So liquidity ratios are also known as capital ratios. So ukiambiwa define liquidity ratios or capital ratios, it means all the same. So formula of calculating, they are, what are the components of liquidity ratios? 1, current assets and current liabilities. Current assets and current liabilities. So number A, we start by getting the formula of calculating current ratios. Current ratios. And current ratios is equals to current asset divided by current liability. Current ratios is equals to current assets divided by current liabilities. We write something. This ratio indicates the number of times the current liabilities can be paid from current assets before these assets are exhausted. That's why tumesema it's current assets divided by current liabilities. It is recommended that the ratio be at least 2:0, i.e. the current asset must be at least twice as high as current liability. So ukiona current liability yako iko juu kuliko current assets, then the company is not moving the right directions. So upate kama current current ratio is 2:6, that company is heading to the wrong direction. So we have an example. We have years, number of years, that is 2004 and 2005. 2004 and 2005. And current assets in 2004 were 26,400, and current assets in 2005 were 15,600. Current liabilities were 13,160 for that is for 2004, and current liability for 2005 was 6,400. Net working capital is equals to current asset minus current liability. For 2004, that is 13,240, and for 2005, net working capital is 9,200. Our question reads, compute the current liquidity ratio for the company and analyze the ratios. Compute the current liquidity ratios for the company and analyze the ratios. That is for you. It's not for me. So tackle that one. Leave your answers in the comment section. I'll check them later. So comment your answers using the same formula that I've given you. That is current ratios is equals to current assets divided by current liabilities. So from there hiyo nitamark. So tafadhali try to tackle that one. So B, quick or acid test ratios. Quick or acid test ratios. What are these? It is a more refined ratio than the current ratio in which the stocks are executed, as they may not be easily converted to cash. The ratio indicates the firm's ability to pay the current liabilities from the more liquid assets of the firm. That is quick or acid test ratios. And under that tumesema how to compute. It's current assets minus stock divided by current liability. Quick or acid test ratios ukiulizwa is equals to current assets minus stocks divided by the current liabilities. And C, that is other liquid ratios, cash ratios. This is a refinement of the quick ratios, indicating the ability of the firm to meet its current liabilities from its most liquid resources. Short-term marketable securities include commercial paper and treasury bills and other short-term investments. Cash ratios is equals to cash plus short-term marketable securities divided by current liabilities. Cash ratios is equals to cash plus short-term marketable securities divided by the current liabilities. From there we shall go to our number 2 type of ratio, that is turnover ratio. And we shall start from there next time. So go through that notes, try to understand. If it's cramming, try to cram them, because those calculations are very important. And let's meet some other time, same place. Thank you very much. Endeleeni kunifollow, kunisubscribia, kulike, kuwatch, kucomment. Please. And if you have your colleague, mwelezee. Hatulipishi. Just have your data and you are good to go. Thank you very much. Have a nice time. Thank you.